Thanks for joining us on lunch. This is Bloomberg Quint. I'm Asha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Majority of exit polls have predicted the Bharatiya Janata Party-led National Democratic Alliance will return to power on the 23rd of May.
Indian equity benchmarks trade nearly 3% higher after the exit polls. The rupee gains by 1%.
Tata Motors earnings may slump in line with peers in the automobile sector, while inventory gains and higher marketing margins may aid HPCL and BPCL.
Oil gains after the Organization of Petroleum Exporting Companies or the countries or the OPEC and its allies agree to keep supply constrained for the rest of the year.
All right, let's kick off the show with a reminder of what the exit polls showed over the weekend. The BJP-led NDA government will come back to power with a thumping majority. That seems to be the suggestion coming out from exit polls. Kaushik Vaidya is here to summarize what we know from the exit polls now.
Prime Minister Modi seems to be on track to do what Rajiv Gandhi could not, what P.V. Narasimha Rao could not, what Vajpayee could not, and probably join Prime Minister Manmohan Singh, Indira Gandhi and Jawaharlal Nehru in being able to win a second term, returning to power, staying in power. Much of this is moving around 3 or 4 key states. Let's get you the national picture first. You're seeing exit polls predict results on Thursday to be likely in the range of around 270, 280 for the NDA, to an upper limit that's being projected around 350 seats by a couple of polls. Within that, let's break this down for you. In Uttar Pradesh, that state, and bring down where some of these gains and losses are coming. Amongst India's biggest states, the NDA is expected to drop about 20-25 seats in Uttar Pradesh as a result of that combination of the Samajwadi Party and BSP. That is being made up more than equally by West Bengal, where the BJP is likely to get an unprecedented double digits in seats. Anywhere between 10 and 12, according to some polls, and others predicting more, which is giving an average of 15. So a gain of 13, 14 seats there. And then Odisha, where again 10 or 12 seats. That's making up for any potential losses in Uttar Pradesh. Across central and West India, where the BJP was traditionally strong in the 2014 general election and subsequent assembly elections, the party has been able to hold on to its own. So in Madhya Pradesh, Rajasthan, Chhattisgarh, where it lost power in the assembly, it's likely to repeat close to what it got in 2014. In the state of Maharashtra, where it stitched an old alliance back, is likely to hold on to much of those gains that it made in 2014. In the state of Karnataka in the south, the BJP is likely to increase its vote share, and it's projected to increase its seat tally if any of these numbers are anything to go by. Which should be remarkable given the fact that it's faced a united opposition, and despite that opposition unity, it may look like it might increase its tally, Harsha.
Interesting that. Let's wait and watch how this unfolds on Thursday. Meanwhile, markets heralded the exit poll forecast with the benchmark indices gaining over 2% each. Yatin is here with some of those key movers today. Yatin.
What a day it has been for the markets, and clearly speculation on how really can BJP increase its tally, get a majority. Of course, we will wait for the results, but before that, the markets have seen a strong rally, nearly 350 points up on the Nifty, almost 1,000+ points up on Nifty Bank as well as Sensex. If you look at the Nifty advance decline ratio, 9 advances to 1 decline. So clearly, very, very favorable market breadth in trade today. The volatility index, India VIX, has also fallen significantly. Volatility premiums have fallen significantly, almost 20% down for the VIX index, clearly showing that how really a lot of positions are changing hands. The obvious ones, the Adani Group stocks are in focus. All of them are up in double digits, be it Adani Port, Adani Enterprises. All of these usual suspects are up on the back of speculation that India is coming back to power. Of course, it's also largely relating to the Australian parliamentary elections verdict also, which have been seen as a favorable thing for the Adani Group. Indiabulls Housing Finance, SBI, Yes Bank, all of these heavyweights are trading with strong gains. On the flip side, Dr. Reddy's, which disappointed with the results last week, is down 7%, top Nifty loser at this moment in time. So is the case with Bajaj Auto, down 1% after the earnings and muted commentary. The IT pack continues to remain weak, so we have Infosys as well as Tech Mahindra, all of these stocks quite weak in trade. But we need to mention all the heavyweights like Reliance Industries, ICICI Bank, Axis Bank, SBI have been moving 5-6% on huge volumes. So clearly, a lot of action in the large cap end of the market today.
Jonathan, thanks for that. Foreign investors say Modi's return is good news for Indian equities. Jonathan Garner of Morgan Stanley and Jim Walker of Aletheia Capital say they'd rather wait till the final tally to come out on the 23rd of May before pumping in more money.
We are bullish Indian equities. We reiterated that view a couple of weeks ago at the same time as shifting more cautious on markets like China. So I think this is an important piece of the jigsaw puzzle in terms of government stability. If you look at global emerging markets funds, their position in India peaked around about the time that Mr. Modi was elected, sort of 5 years or so ago, to form the government, and that was at an all-time high weighting. Since then, that's moved somewhat lower. However, global funds are still about 200 basis points overweight India, but that's towards the low end of the historical range. And we're certainly happy to recommend an overweight position and that investors should reaccumulate, foreign investors who've been tending to reduce. I do think it's also important to remember the domestic investor base has changed significantly in the last 5 years in relation to domestic mutual funds. And again, what we seem to be getting is an environment where inflation will remain relatively subdued. The budget deficit path won't be that different from what we've seen in recent years. And that will keep bond yields on a nice sort of medium-term downward trajectory for India, which is very supportive for equity valuations.
Well, I think from a foreign investor perspective, it's probably viewed with some relief that there's going to be continuity in India, relative stability at the heart of government and policy. And I think that's certainly a positive from the perspective of foreign investors. Although I don't see the same kind of enthusiasm as was the case in 2014 for Mr. Modi and his agenda. I think there won't be the same immediate response to this election. I think people will want to see something happening on the legislative front, and especially as regards the economy.
All right, let's get another view. Obviously, just like equity markets, we've seen the currency markets pick up as well. Bond yields are down a touch this morning. Jayesh Mehta is Managing Director and Country Treasurer at Bank of America. Is joining us on the phone line. Good afternoon, sir. Thanks for taking our call. Currently, it looks like the sentiment boat is lifting everybody, all assets, whether it's rupee or equities, and to some extent bonds.
Yeah, so I think all asset class doing well and should be doing well. Of course, currency, if you look at it, yeah, we have our problems irrespective of the election results. But especially oil is not, giving you on and off kind of pain. And of course, you have fiscal deficit. But, things could really change if we see large flow momentum continuing on the equity side and even on the bond side. Then in that situation, we would have some appreciating bias to the currency. Otherwise, it's well priced right now at this level. But if that flow comes in, then the only thing which can really stop, of course, RBI buying. So that would be maybe another 0.5%, maybe like 68, 69. Is where you see RBI coming and buying in if there is an FPI flow coming in with that.
Once this event is out of the way, Jayesh, I mean, what happens next week? I mean, the problems facing the economy haven't gone away. So what would the markets be contending for when they come into work next week?
So I think, one is on the economy side. I think one of the biggest thing, and I think people have realized, and also ministry has been meeting a lot of people, and also is going to RBI too. I think one of the bigger challenge, while we may say all the previous thing on DMOT or GST and all that, I think one of the bigger challenge for our economy is our banking system in the credit side was missing, right? And I think if that gets corrected, and I think this is going to be one of the top agenda for the government, is to growth which should be supported by banking system also, not only a growth led only by NBFC. I think that is a big change we need to do, and all eyes and focus will be on that. If we get that right? And then things could really change for everything, including growth and for the banks and everything. So I think that's the biggest challenge we are facing right now is in last 4 years, 3 years, we actually missed the banking system to lend to the economy.
Mr. Mehta, slightly more near term. So, equity flows have been positive, but bond flows were negative last month, and this month also, early part of the month, they were negative. If there's a revival in sentiment from the FPI side, do you think money will come into bonds as well? Because bonds have a different problem than equities right now, which is obviously, the fiscal deficit, the high public sector borrowings.
So that's where it is, right? So if we are going to change that's where the push is. That in last 4 years we have changed the style. Is like when you cut rate, normally you keep surplus liquidity, and when you raise rate, normally you keep negative liquidity. But last 4 or 5 years we have been actually doing negative liquidity, irrespective of whatever we do on the rate side. But if we are able to get that, if central bank is changing that stance, we need to see that. And then in that case, your supply side of the bond will be well curtailed by OMO, and even the liquidity, whether it comes to swap, even that will support the bond market too, because at the end of the day, a swap would give you reasonably priced money, but you need to still buy assets. So all that put together, we will see definitely the flow. But of course, I think the stance need to really, I think people OIS market would look at rate cut, whereas the bond market would look at liquidity.
Mr. Mehta, there have been some reports in agencies like Cogensis that the government intends to have a conversation. The new government that comes in perhaps will have a conversation with the RBI about the liquidity conditions, also arranging some sort of a line for NBFCs. To your mind, are those critical decisions that need to be taken quite quickly once the new government comes in?
I think definitely. So I think two things. One is very clearly, which is what I was trying to say, is the stance on liquidity, because rate and the liquidity needs to go together. Standalone, each one of them will not work. So if you have a rate cut situation, then you need to have surplus liquidity. If you have a rate hike situation, you need to have negative liquidity. And again, both surplus and negative need to be at a level, right? It can't be haywire. So like earlier, we used to maintain 0.5% of NDTL, maybe 70,000-80,000 crores surplus or 70,000-80,000 crores negative, depending on the cycle. That needs to change. In terms of NBFCs, yes, it may not be a systemic issue, purely from the size of it, but it can get into a credit confidence issue. And if it gets into a credit confidence issue, it can impact larger other sectors also. And therefore, it is very imperative that we get banking back into the play. Like, if you really look at, banks have not been really lending, right? So we need to get banking back into the play. Without that, this smaller problem can become much larger. In terms of NBFC getting financed, that's what people are asking by RBI, looks little challenging. What they had done something in 2009, though it was not used, was an SPV guaranteed by the government, and that was being funded by RBI. So something on that line. But, I think it's more, once we have liquidity and banks start lending, I think a lot of things should be taken care of. But yeah, that should be the priority.
All right, Mr. Mehta, thank you so much, sir, for joining us for that quick take on a day when equity markets and currency markets are rallying, bonds gaining as well.
Orix Corporation is outbid GAIL for IL&FS wind energy assets. The Japanese company, which owns 49% stake in each of the 7 power plants, offers to buy the remaining stake. Vishwanath Nair is here with details on this one. Vishwanath.
Right. So, as you said, Orix, Japanese investment firm, they're interested in taking over the 7 wind power assets that IL&FS has been trying to sell for a while now. So they are matching what GAIL had offered, because it's part of their contract that if a bidder comes for the assets, then they have the right to also match that offer and take over the assets, which they did. So at about 4,800 crore, it's been valued at, the company has been valued at. So they will take over 100% equity in the company. The lenders to these wind power assets, they have an exposure of about 3,700 crore. That will be fully settled without any haircut, according to what the company's press release says. Alongside this, they're also trying to monetize assets across 6 different business verticals: water infrastructure, education, aluminum, thermal power, all of these different business verticals, and there are about 55 assets that the company is trying to sell and recover money. But the amount associated with those assets is about 40,000 crore. Of that, this represents about 4,800 crore. So it's important to see, whether the same run rate continues for the remaining assets, because that 98,000 crore debt that IL&FS owes to different bankers needs to be repaid at the earliest, and selling off assets is probably the only way right now that the new board can ensure that some of these lenders are paid off and that more calls for repayments do not turn up. We still need to see what happens to those 55 assets on sale. According to the company, they'll close it by the end of July, so about 2 months to go. So we'll get to know what happens in those assets. But yes, IL&FS first signs of sales seem to be promising.
Thanks so much for that, Vishnath. Two of Religear's top bosses have alleged wrongdoing on the part of its promoters, Malvinder and Shivinder Singh. They allege that the Singh brothers colluded with the then chairman and MD of Religear Enterprises, Narendra Ghosal, a long-time associate of the Singh brothers, to get funds from the NBFC without proper documentation. Sajid Mangat, who has a copy of the complaint, joins us now with details. Sajid.
That's right. This complaint relates to the December complaint done by Religear and Religear Finvest, which is the NBFC arm of the entire group, to Ministry of Corporate Affairs. As part of the investigation, the ministry has asked for responses from 4 individuals against whom the complaint has been lodged with the MCA, which includes the Singh brothers, which is Malvinder Singh and Shivinder Singh. Aside of that, the former chairman and MD of Religear Enterprises, which is Sunil Godwani, and Narendra Ghoshal, who is a long-term associate of the Singh brothers. As per the entire complaint, which has been reviewed by Bloomberg Quint, the complaint says that over a period of last 10 years, roughly around 48,000 crores of money has been loaned to various entities on multiple times. So it's not the total exposure is 48,000 crores, but multiple times this loan has happened, and that amounts to nearly 48,000 crores. And as of the date of the complaint, which is in December, the company Singh brothers owes roughly around 2,800 crores, including interest from at least 19 entities. These 19 entities have also been part of the IBC proceedings, because Religear has taken them to IBC to recover the money, and at that point in time they realized that the entities had borrowed money on the instruction of RFL, which is Reliance Finvest, and given it across to entities of Singh brothers. The modus operandi is pretty much violations of how loans are given by Religear Finvest, which also came out during the audit of Reserve Bank of India. It also talks about how dispersals of loan were done on oral instructions by entities or individuals closer to the Singh brothers, and without proper documentation. The then CEO and CFO would authorize, and then all the procedures would have been, once the dispersal used to happen, they used to go for all the process so that all documentation is done for that particular loan. Sure.
Saji, thank you for that. That's the story on the Singh brothers. Tata Motors earnings may slump again after a forgettable December quarter. This time, the domestic auto sales to slow down is likely to hurt growth. Yatin is back with us with the street expectations for both Tata Motors and for JLR. Yatin.
Harsha, as you rightly pointed out, a lot of headwinds this time. Apart from China slowdown, we have the diesel car issue in Europe, US slowing down, trade war issues, domestic slowdown. So all of that could weigh on Tata Motors' consolidated earnings this time. In fact, if you look at the Bloomberg poll, that is showing a decline of nearly 6.5% as far as consolidated revenues are concerned, and profits are also seen lower by nearly 73% on a year-on-year basis because of lower profitability as well as forex losses. Consolidated margins for Tata Motors are seen at close to 10.5% range versus a level of nearly 11.9% last year. If you look at JLR also, this time because of lower volumes, we could see revenues down by about 9%, EBITDA down by about 35%, and profits because of the impact of foreign exchange as well as other expenses could get a hit of nearly 80% year on year. JLR entity margin is seen at 9.5%, the most important figure that analysts do watch out for. Of course, this 9.5% margin number would be lower by about 200 basis points on a year-on-year basis. Of course, apart from the financials. At the 4:30 press conference, we will be asking the management about the view on China and US trade war, as to how really does that impact them. Do they see pick up in volumes for the domestic market as well as for the Chinese market, which have been quite important. And of course, Brexit is something important, and the management view on that is also something that we'll be keenly watching out for, apart from the earnings.
Yatin, thanks so much for that. Inventory gains and higher marketing margins may aid BPCL and HPCL's earnings in the fourth quarter. Samit Sarkar joins us with the expectations.
Well, for BPCL, if you see on a standalone basis compared to last quarter, the numbers are expected to be strong. The revenues are expected to be down by nearly 5%, but the net profit and the EBITDA of the company is expected to see a jump of nearly 5.5 times. The company's margins are expected to come in at close to 5.4%. Now, if you see on the operational side, the gross refining margin, that is expected at close to $4.6 per barrel, while the crude throughput of the company is expected to be higher by nearly 6%. The sales are expected to be higher by nearly 5.7% compared to last quarter. Now, for HPCL, if you see compared to last quarter, the revenues are expected to be down by nearly 6%, but the company's EBITDA is expected to see a jump of nearly 3.7 times. Margins are expected to come in at close to 5.2%, while the net profit of the company is expected to see a jump of nearly 8 times compared to last quarter to close to 2,000 crore rupees. On the operation side, the company's gross refining margin is expected to come in at close to $4.6 per barrel. For the company's crude throughput, that is expected to be low by nearly 1.3%, and that is because of lower runs at its Mumbai refinery, but the company's sales are expected to be higher by nearly 3% to close to 10 million metric tons compared to last quarter. Now, if you see, it is expected to be a strong quarter for both the oil marketing companies because of a possible inventory gain and because of higher gross marketing margins that they have earned in the fourth quarter. However, some of these positives will be offset by a lower gross refining margin in the fourth quarter. Now, if you see in the fourth quarter, Brent crude averaged at around $63.7 per barrel versus $68.8 per barrel in the last quarter. Now, though crude has averaged lower in the fourth quarter, it has posted its highest quarterly gains in the last 10 years, because of which the oil marketing companies could possibly report an inventory gain. On the marketing side, if you see, the gross marketing margin earned by HPCL and BPCL in the fourth quarter was the highest in at least the last 4 years, because of which we can see a bump up in the marketing segment. However, some of these positives will be offset by lower Singapore gross refining margin, that is the Asian benchmark, that averaged at around $3.2 per barrel, which was the lowest in at least the last 6 quarters. Lastly, key things to watch out for from both the earnings would include the inventory and the foreign exchange gains that the company reports. Along with that, the debt levels of the company, which is expected to be higher because of the rising subsidy burden. Along with that, their outlook on the refining and marketing margin and the capital expenditure plan for financial year 2020 would be important to watch out for from BPCL and HPCL earnings today.
Saman, thank you for that. Oil started the week on a strong note after OPEC and its allies said they intend to keep supply in check for the rest of the year. Russia was the sole voice of dissent. Russian Oil Minister Alexander Novak says curbs may be relaxed based on developments over the next month.
We are, of course, always reviewing a number of options based on where the market is heading and what is happening in the market at the moment. At the same time, we have come to a conclusion here at the JMMC that we need to continue cooperation with our partners in order to ensure market stability. But the concrete parameters which would govern our actions in the second half of 2019 will only be set in Vienna in a month's time. Then we can tell you in more detail. But once again, I can say that we're reviewing various options, including relaxing the production limitations if market demands that and if there is a deficit which we need to cover.
Russia just came into compliance in early May. It also correlated with this contaminated oil scandal in Russia. Do the two have anything to do together? Is that how Russia was able to reach their quota and comply because of this lost barrels of oil to Europe due to the contamination?
No, this is absolutely not so, and these things should not be linked. We can say that we have reached our targets back in April, and the Russian companies which are operating in our markets have cut their output in accordance with the volumes which have been agreed. I reached 100% conformity.
Out of time on the show. Thank you so much for watching.